This is educational content, not financial advice. Always do your own research and speak with a qualified financial advisor before making any investment decisions. Have you checked your energy bill lately? Because the forces that drove it sky high a few years ago are quietly building again. European gas storage is at its lowest level in years, heading into the heating season, and if winter arrives cold and supply stays tight, the ripple effects could hit everything from your utility bills to the stocks in your portfolio. Let us walk through what is happening and what it could mean for you as an investor. The headline number is stark. Europe's gas storage is sitting at around 46 billion cubic meters heading into summer. That matters because summer is when storage is supposed to be filling up, not depleted. The target has historically been to enter winter with tanks as close to full as possible, typically around 90% or more. Right now, the math is not working in Europe's favor. To put 46 billion cubic meters in context, storage was around 77 billion cubic meters at the same point in 2024. That is a gap of roughly 31 billion cubic meters, a decline of about 40% year on year. Europe is essentially starting a marathon with less than half a tank of fuel compared to 2 years ago. The buffer that kept the continent from a full-blown energy crisis in recent winters is thinner than it has been in years. How did we get here? Several factors converged. Ongoing reductions in pipeline supply from Russia have left Europe scrambling for alternatives for several years now. A colder than expected winter drew stocks down further than forecast, and now the Iran conflict and disruption around the Strait of Hormuz, one of the world's most critical energy choke points for global LNG, is tightening liquefied natural gas markets at exactly the wrong moment. Europe's pivot away from Russian pipeline gas made it far more exposed to these global LNG swings than it was before 2022. Here is the uncomfortable arithmetic. To reach a safe storage level before October, Europe would need to inject gas at an aggressive pace through summer, while competing for the same LNG cargoes as Japan, South Korea, and China. Higher competition means higher prices, and higher prices mean the refill process is both costly and uncertain. The window to build comfortable reserves before winter heating demand kicks in is narrowing. Weather is the wild card. An average or mild winter might let Europe muddle through with lower storage levels. But a cold winter is a different story. Low starting inventory combined with high heating demand could drain storage faster than it can be replenished, pushing wholesale gas prices sharply higher, the way it happened in 2021 and 2022, when prices shocked businesses and households across the continent. European gas futures are already pricing in some of that risk premium for this coming winter, and the risk of a repeat, while not certain, is meaningfully elevated. When energy prices spike, the pain is not distributed equally. Energy-intensive industries, steel, aluminium, chemicals, fertilizer, face sharply higher input costs with limited ability to pass them on quickly. Households redirect disposable income toward energy bills and away from discretionary spending, pressuring retailers and consumer companies. The winners tend to be the companies selling the energy. Upstream producers and utilities with exposure to gas pricing. European utility stocks and integrated oil and gas majors often draw attention in energy spike scenarios. Companies with gas generation, LNG operations, or production in Norway can see earnings benefit when prices rise. But not all utilities are equal. Some have regulated revenues insulated from spot price moves, others are fully exposed, and commodity producers are volatile. What climbs on a cold November can fall hard on a mild December. Understanding the revenue mix matters as much as the sector label. This is education, not a stock recommendation. On the other side of the trade, energy-intensive industrials, especially chemicals, which use gas as both energy and feedstock, see margins compress quickly when prices spike, and household budgets feel it too. As heating bills rise, spending on restaurants, travel, and retail tends to fall. One reason energy shocks drag on broader GDP growth. If you hold names in either space, understanding their energy cost exposure and hedging policies is a reasonable due diligence step. A word on perspective. Energy price risk is one factor among many in a well-constructed portfolio. Broad European equity indices mix sectors that benefit, sectors that suffer, and many that are relatively insulated. So, a well-diversified investor will not feel the full force of a spike in either direction. These scenarios matter most for concentrated positions or sector-specific bets. Portfolio construction is always your first line of defense. Being aware of a risk is not the same as being obliged to act on it. There is a longer-term angle here too. Each episode of gas price pain reinforces the case for accelerating Europe's energy transition. Offshore wind, solar, and battery storage all become relatively more attractive when gas dependency looks riskier and more expensive. And European policymakers have consistently used energy crises as moments to push green investment harder. That structural trend is unlikely to reverse, regardless of what happens in any given winter. If you want to track this story through the summer, here are the data points worth monitoring. Weekly storage injection figures from Gas Infrastructure Europe tell you whether the refill pace is on track. LNG spot prices reflect global competition for supply. Hormuz developments affect risk premiums, and the Dutch TTF gas futures price gives you the market's own live forecast for where winter energy prices are heading. The 2021 and 2022 energy crisis is the clearest precedent. Low storage plus a supply shock produced price levels that would have seemed impossible a year earlier, forced some smaller suppliers out of business, and reshaped European energy policy in ways still unfolding today. Rather than telling you what to do, here are the questions worth asking about your own holdings. Do you have concentrated exposure to energy-intensive industries? What does your utility allocation look like? And are those revenues market-linked or regulated? How much European consumer discretionary exposure do you carry? And fundamentally, is your portfolio diversified enough that a sector shock in either direction does not dominate your returns? Good investing is about asking the right questions before the crisis, not after. The critical monitoring moment comes in September and early October, when the summer injection season draws to a close, and we will know whether storage has recovered meaningfully or Europe heads into peak heating demand with inadequate reserves. Most long-term investors are best served by maintaining their strategy and using a moment like this as a prompt to review holdings, not to make reactive trades. Being informed going into autumn beats reacting to a spike. Let us bring the key points together. European gas storage is sitting at around 46 billion cubic meters, dramatically below the 77 billion at the same point 2 years ago. The Iran conflict and Hormuz disruption are tightening global LNG markets at the worst possible time. If winter is cold and supply stays restricted, a second energy price spike is a real possibility. Utilities and energy producers could benefit. Energy-intensive industrials, chemicals, and consumer companies face headwinds. Weather is the wild card, and diversification remains your most reliable buffer against any single sector shock. If you found this episode useful, please like this video and subscribe to The European Investor. We cover the issues that matter most for European retail investors in plain, straightforward English. There is a link in the description to our free newsletter where we track stories like this one through the season. As always, everything on this channel is education, not financial advice. Do your own research, consult a qualified professional, and invest with your eyes open. This is The European Investor. We will see you in the next episode.